Join us now on the markets as the Fed kicks off its latest policy meeting. Oksana Aronov, head of market strategy for alternative fixed income at JPMorgan Asset Management. You're still, and it's good to see you. Thanks for joining us. You're unsettled a little bit, I think, about what the Fed is ready to embark on. And I think you'd say 25 makes more sense because inflation, they're ignoring some recent hot numbers as if they've conquered inflation.
Correct. I mean, I think I'd say that a cut is not necessarily even warranted, given that we're not really seeing a broad-based weakening outside of a more reasonable labor market, right? Labor or unemployment rate of 4.3% is certainly well within the Fed's own sort of 5% target, which they consider neutral on unemployment. So we went from extraordinarily tight labor markets to sort of a more normal. But outside of that, this morning, again, another beat on the retail sales. And we continue to see just broadly the economy is doing fine. These rates have not been as restrictive as the Fed, I think, expected at the short end. And making them less so is going to probably loosen financial conditions further, which are already the loosest they've been since before the Fed started fighting this inflation.
I just don't understand why we can't have a definitive answer to whether restrictive or not. So someone like you can say they shouldn't even cut. Other people are saying they're so far behind the curve they should do 75 basis points. Everybody's looking at the same data, and you can come to just completely polar opposite is opposite's enough to say, but opposite conclusions. How does
I think everyone is looking for what they want to see, but objectively speaking, even on the inflation data, right? When we were sitting here in June of last year and CPI year over year was 3%, and everyone considered inflation moving towards 2%, right? We're sitting here 14 months later, and where is CPI? 2.9%. It took us 40, and by the way, there was a lurch towards the high threes in between there, right? So I think it kind of goes to show what we've been saying all along, which is that we are going to be stuck in this churn for quite some time, and the Fed's own, our star, expectations are moving up, right, from 2.6 in March to 2.8% more recently, and I think that will continue to be the case. So they should move quite carefully here. 25 is probably enough to buy them some time to see some more data. And unless we see really a decisive move towards that 2% inflation, which I think will continue to be elusive for a number of factors, not the least of which is the amount of fiscal spending, which is not going to stop. It's going to continue unabated, irrespective of who occupies the White House.
And they shouldn't worry about Wall Street's reaction, because that will probably be disappointing at this point, 25 basis points.
And if that's really what's guiding them, that's really not the right incentive, right? They seem to have dispensed with sort of price stability, or at least put it on the back burner right now, and they're focusing on the unemployment picture. But again, outside of unemployment, which is simply slightly more normal, you're not really seeing broad-based weakness. GDP was revised higher. Like, the economy is continuing to chug along. There's really no impetus to be alarmist here.
And it's nice to have something in the tank, isn't it?
Exactly.
If there is a downturn.
Exactly.
So do you, people are expecting 150 basis points, 200 basis points.
Well, that's certainly what the long end is pricing in right now. And so my question to the broad-based, right, industry-wide in asset management context and duration is, what are you going to get from that? The 10-year is already pricing in something like 200 basis points of easing, right? So unless you have really a pretty significant recession, that's wildly overdone. So I would say that that's a trade that's run its course, and you should be moving towards different types of opportunities.
So if you were Jay Powell, would you stay right here? If you could make this, you'd stay right here and see what happens?
I'd stay right here and see what happens. There's absolutely no exogenous shocks to the economy right now. They may come, and you want to have plenty in the tank to deal with them. There's really nothing pushing him towards making any significant moves here. And isn't this similar to 21, early 22, when they continue to believe that inflation's transitory? To me, this is sort of like, haven't you learned your lesson? You can't claim victory until victory has actually been achieved, or until there isn't that exogenous shock that requires action.
You don't think we're in the middle of a lag period where the restrictive, if we are restrictive right now, where eventually that is going to, you could be overcooking the restrictiveness. That's not, you don't think so?
We just don't see it, again, broadly in the data outside of the slightly more
Are we
normal.
restrictive at all right now?
Not when you look at financial conditions and how loose they are, right?
Add those in.
Yeah. And so you're just not really seeing it. In terms of the consumer, which continues to be strong, you look at Walmart, Target, Costco, right? All of those earnings came in fairly strong. You're just not seeing this broad-based weakness that would necessitate this kind of action from the Fed.
I wonder what caused it. I think we've all been conditioned to just love
lower rates
and easing and.
Yes.
And
absolutely, that's what 15
that's not the real world, though.
Extraordinarily, that's what 15 years of extraordinarily unorthodox monetary policy will do to a market.
It's just people that have never known anything other than mainlining cheap money into their.
And when they think of normalization, I wonder if they realize that the average Fed funds rate historically has been around, the mid-fives. If we exclude the extreme, the 20% extremes in the 1980s, that's 4.6% still. And we are, not that far away from it. So I think even if the Fed continues with cutting, and this is really important, if they get us into the high fours or mid fours, number one, they risk reaccelerating inflation, I think. And number two, that's still very high borrowing costs for a lot of corporate balance sheets that are kind of junk balance sheets that are simply not going to survive. So I think credit volatility will continue, bond volatility will continue, and the fiscal dominance that we are seeing from whichever administration takes over the White House, right, that's just going to continue. That's going to also keep a floor on the long end of the curve.